Repo rate is the rate at which the Reserve Bank of India, which is the central bank of India, lends short-term funds, generally on an overnight basis, to the banks in case of shortfall of funds. The funds are lent against a collateral of government securities and other approved securities. Repo rate is an important instrument of monetary policy used by central banks around the world to control inflation. Yesterday, the Reserve Bank of India increased the repo rate by 50 basis points or 0.5%. The repo rate was hiked to 4.9%. What does this mean? This means that commercial banks will now have to pay a higher rate of interest to the Reserve Bank of India. This will make the borrowings expensive for the commercial banks. The commercial banks, in turn, will increase the rate of interest which they charge from businesses and industries. This will make the borrowings expensive for businesses and industries, who will then stop borrowing from the banks. This will slow down investment and reduce the money supply in the market. This will help in controlling inflation. The Reserve Bank of India reduces the repo rate when it has to increase the money supply in the market. Now coming to the reverse repo rate. Reverse repo rate is the rate of interest which the commercial banks get when they deposit their excess funds with the Reserve Bank of India. The Reserve Bank of India increases the reverse repo rate when it has to control inflation. The commercial banks deposit their excess funds with the Reserve Bank of India when they get a higher rate of interest from the Reserve Bank of India. This helps in reducing the funds available with the commercial banks. This ultimately helps in reducing the money supply in the market and helps in reducing inflation.